Hi guys, this is Sia Jane and welcome back to my channel ACCA and Beyond. So, we'll continue with our revision series of Audit and Assurance, and today's chapter is going to be chapter number 8, Systems and Control. So, let's get started. So, in business technology, we covered the basics of an internal control system. Now we take it a step further and understand how a client's internal control influence the audit approach and the audit evidence gathered. So, what's the key idea here? It's all about control risk. One of the major factors affecting the risk of material misstatement. If a company's internal control system is well designed, properly implemented, and working effectively, the chances of material misstatements are much lower. Why? Because strong controls either prevent misstatements from happening or detect them early and ensure they are corrected. And this is exactly what the auditor cares about. Based on this assessment of control risk, the auditor then decides the audit strategy and the audit plan. Okay, so let's understand the impact of test of controls on the audit strategy and audit plan. The key rule is simple. The extent of substantive testing depends on the auditor's assessment of control risk. First, if control risk is low, this means internal controls are reliable, so the auditor can place more reliance on internal controls and internally generated evidence, perform more interim audit testing, and reduce the quantity of detailed substantive procedures at the final stage. As a result, the audit plan is updated with fewer procedures and smaller sample sizes. Now, if control risk is high, this means the controls are weak or unreliable. The auditor will increase procedures at and after year end, perform more substantive procedures, especially test of detail, expand audit scope to more locations, place less reliance on analytical procedures, place less reliance on written representations from management, and obtain more external evidence like confirmations from customers and suppliers. Basically, more risk equals to more work for the auditor. Finally, remember this point. Even with strong controls, the auditor can never eliminate substantive procedures completely. Why? Because of the limitations of internal controls, such as human error, ineffective controls, and the conclusions of staff where employers bypass controls together. Even the best controls are not perfect. One major limitation is management override. This is the abuse of power by those with ultimate control. The management can falsify accounting records or post unauthorized journals to present a different result in the financial statement. Um, Another key limitation is the use of management judgment. Management decides the nature and extent of controls, and sometimes they may choose not to implement controls if they feel the cost outweighs the benefits. Because of all these limitations, remember this rule. The auditor must always perform substantive testing on material balances, no matter how strong the controls appear. Now, let's quickly look at the examples. Human error. Uh, Actually, I think you can just go through them. I don't need to explain them in the revision video. Let's start with the next page, okay? Okay, so let's look at the components of internal control. According to ISA 315, the auditor must understand an entity's internal control system, and to make this easier, it is divided into five components. Let's start with the first one, the control environment. And these components are like important. They are examined in different ways in your exam. So yeah, just focus. The control environment includes the governance and management functions of an organization. It focuses on the attitude, awareness, and actions of those responsible for designing, implementing, and monitoring internal controls. In simple terms, it sets the tone of the organization and provides a foundation for all other components of internal control. Now, what are the key elements of the control environment? First, management's commitment to integrity and ethical values. This is reflected in how responsibilities are carried out. Second, independence of those charged with governance and how they exercise oversight over the system. Third, assignment of authority and responsibility to achieve organizational objectives. Fourth, how the entity attracts, develops, and retains content people through recruitment, training, and performance appraisals. And finally, accountability. How individuals are held responsible through performance measures and disciplinary policies. One more important point, when assessing the control environment, the auditor also looks at how management responds to internal audit findings and recommendations, especially when control deficiencies are identified. The auditor must also check whether controls implemented based on internal audit recommendations have been properly evaluated later by internal audit function, mainly through inquiries and observation and sometimes inspection of documents like codes of conduct and organization charts. Now let's move to the second component, that is the entity's risk assessment process. The auditor must understand how the entity identifies businesses relevant to financial reporting, assess their significance, and respond to those risks. Then the auditor evaluates whether the process is appropriate based on the nature and complexity of the business. But remember, the auditor is only concerned with financial risks that affect financial statements. So what are these risks? They are threats to business objectives that can lead to material misstatements. Common examples include new IT systems and technology, rapid growth, new accounting standards, issue in data integrity and information processing, misalignment between IT strategy and business strategy, and interruptions in IT systems due to delayed updates. Now, here's a key insight. If the company has a strong risk assessment process, the overall risk of misstatement is lower. But if the auditor finds that management failed to identify important risks, they must understand why the process failed and consider the impact on the audit approach. Okay, so the third point is the entity's process to monitor the system of internal control. This is a continuous process of evaluating whether controls are working effectively and taking corrective actions when needed. Monitoring can be ongoing or done through separate evaluations or both. And in most organizations, this is a key role of the internal audit function. Fourth, the information system and communication. This includes all activities, policies, and procedures related to financial reporting, both manual and computerized systems. This system is designed to initiate, record, process, and report transactions, maintain accountability for assets, liabilities, and equity, identify and correct errors in processing, handle system overrides, transfer information to the general ledger, capture data for other events affecting financial statements, and ensure proper disclosure of information. In short, this is the backbone of the financial reporting. Okay. Now, the fifth one is the control activities. These are the policies and procedures put in place to achieve management's control objectives. Think of them as the actual actions taken that enforce control. Uh, Authorization, ensuring transactions are valid; reconciliations, checking completeness and accuracy; verification, confirming validity of data; physical or logical controls, protecting assets and data; and segregation of duties, reducing the risk of fraud and error. So, to wrap up all the five components, the control environment sets the tone. Uh, it's okay, I'll not write. Sorry. So, the control environment sets the tone. This assessment identifies risk, monitoring checks if possible checks if controls work, and information system processes financial data, and control activities implements the control. Together, they form the complete internal control system. Okay. Uh, yeah. So a control objective simply identifies the risk that the entity needs to manage. In other words, it explains why a control activity is required. For example, in a purchasing system, there is a risk that employees could make purchases for personal use using company funds. So the control objective becomes to ensure goods cannot be purchased for personal use. And how is that achieved? Through a control activity like authorization of purchase orders by a responsible official. Now let's look at some common examples. Let's look at some examples of control activities. Okay. Authorization. A manager signs off an employee's timesheet to confirm that hours worked are valid. A manager approves a purchase order to ensure the goods are for valid business use. Reconciliation. Preparing a bank reconciliation to ensure transactions are complete and accurate, matching supplier statements with payables to check completeness and accuracy. Verification. Comparing actual spend with budget to detect unusual fluctuations, using batch totals to ensure no data is omitted. Physical or logical controls. Keeping cash in a safe to prevent theft, using password restrictions to prevent unauthorized access to system. Segregation of duties. This means no single person should uh, control all aspects of a transaction. Why? Because it reduces the risk of fraud and error going undetected. For examples, warehouse staff may not perform inventory counts, otherwise theft during the year may go unnoticed. Employees who authorize transactions should not be the ones who initiate them. Now let's to move to direct and indirect control. A direct control is one that directly addresses the risk of material statement at the assertion level, whereas an indirect control supports direct controls but does not target a specific assertion. For example, a manager reviewing total payroll each month is an indirect control, but checking individual pay slips for accuracy is a direct control. So remember, direct is a specific assertion and indirect supports a system. Okay, I'll skip the examples and I'll just move forward. Okay. So now let's understand the IT controls, a very important and increasingly tested area. The level of risk from the IT environment depends on how much and how complex the technology used by the entity is. For example, some companies may use advanced systems like blockchain, others may use basic data entry systems. But regardless of complexity, the auditor must always identify IT applications and systems, understand the risks arising from the use of IT, and evaluate the controls in place to manage the risk. IT controls are divided into two main types: general IT controls and information processing controls. General IT controls ensure the overall proper functioning of the IT environment and support the integrity of the entire system. Examples include access, preventing unauthorized access to systems, database, and networks; program changes, ensuring proper controls over system updates, including segregation of duties and system development controls; IT operations, such as job scheduling, monitoring, backup and recovery, and intrusion detection. In simple terms, general controls keep the system stable and secure. Now, for information processing controls, these controls directly deal with the processing of information and ensure the accuracy and integrity of data. They can be automated, built into systems, or manual, like input output checks. Examples include batch total checks. When entering invoices, the system generates a total number which is then verified by the user to ensure no data is missing. These controls ensure accuracy, completeness, and validity of data. Sequence check, ensuring number sequences are complete and no items are missing. Matching controls, for example, matching sales invoices to prices with the master price list to ensure correct pricing. Arithmetic checks, verifying mathematical accuracy. Range checks, ensuring data entered falls within a reasonable range. Existence check, for example, confirming that employees actually exist. Um, Sorry, that's that. Authorization controls, ensuring transactions are valid and approved before processing. And exception reporting, highlighting unusual items like unexpected changes in employee bank details. Now let's move to ascertaining the systems. How the auditor understands internal controls. The auditor uses several procedures: inquiries with relevant personnel, observation of how controls are applied, walkthrough test, tracing a transaction through the system, inspection of documents like procedure manuals. But here's an important point: inquiry alone is not sufficient. The auditor must use a combination of procedures. Also, while auditors can use prior knowledge, they cannot rely on it completely because systems may have changed. Knowledge must be updated and controls must be tested again, especially for significant risk areas. For areas with lower risk, controls must still be tested at least once every third audit. Okay, just give me a second. Okay, so let's understand how auditor documents a client system. Before evaluating whether controls are adequate and effective, the auditor must first document the system properly. There are several methods to do this. First, narrative notes, a simple written description of how the system works. Second, flowcharts, a diagrammatic representation showing the flow of the transactions. Third question is, these are structured questions about the control systems and are two important types. ICQ focuses on whether controls exist. Questions are usually closed ended, yes or no. And ICEQ focuses on how controls are achieved but are open ended. So, yeah, let's see the quick difference between ICQ and ICEQ. ICQ, um, okay, sorry. Um, ICQ is a bank reconciliation performed regularly. ICEQ, how are dispensaries in the bank account identified and resolved. ICQ, are purchasing orders authorized before placing orders. And ICEQ, how does the company ensure purchases are valid for business use? So this is, I guess, more or less the same, the examples. I'll move on to the next page. Okay, so first narrative notes is the advantages are they're simple to record, easy for all audit staff to understand, but disadvantages can be time consuming, especially for complex systems, difficult to identify missing controls. Second, flowcharts. They give a clear visual of the entire system, make it easy to spot missing controls using standard symbols, but difficult to amend, may require redrawing, still need supportive narrative notes and increasing time. Third, ICQs. Quick to prepare using standard formats helps ensure common controls are covered, but controls may be overstated. Client knows yes is expected, so unusual controls may be missed. May include irrelevant controls. ICQs requires descriptive answers, not just yes or no. So controls are less likely to be overstated, still relatively quick to prepare. Controls may still be overstated by the client, may include irrelevant objectives, unusual risk may not be identified. Okay, so, uh, okay, sorry. Let's move to the testing of the system, also known as test of controls. Test of controls are only performed on controls that are properly designed and actually implemented. In simple terms, the control must be capable of preventing or detecting misstatements, and it must exist and be in use. If a control is not designed or implemented properly, there is no point in testing it. Now, what are the common methods of testing controls? First, observation. For example, observing an inventory count. Second, inspection. Checking documents for evidence like authorized purchase orders. Third, test data. Inputting data into systems to check if automated controls work properly. Okay. This is a very important concept, designing valid test of controls. First, the auditor must clearly identify which control is being tested. Remember, a control is an extra activity added to ensure the system works correctly. Here's a key mistake students make. Just because no errors are found does not mean the control is working. Why? Because there have been no errors to begin with, or there may have been no control at all. Let's take an example. If the client says they perform bank reconciliations, the auditor should inspect the reconciliation to confirm it is done and re-perform it again to check accuracy. But simply doing the reconciliation yourself and finding no difference does not prove the client performed the control. Similarly, if the auditor checks a sequence of documents and finds it's complete, that does not prove the client perform complete. That does not prove the client performed a sequence check. It just means nothing went missing. Okay, let's understand with communicating control deficiencies. According to ISA 265, the auditor must communicate important deficiencies to management and communicate significant deficiencies to those charged with governance. So, what is a deficiency? A deficiency exists when a control is poorly designed, implemented, or operated and cannot prevent or detect misstatements, or a necessary control is missing completely. Now, what makes a deficiency significant? A significant deficiency is one that deserves the attention of the TCWG. To decide this, the auditor considers factors like the likelihood of material misstatements, the risk of fraud or loss, the complexity and subjectivity of accounts, the size of balances affected, the volume of transactions, the importance of the control in the financial reporting, the frequency of errors detected, and how deficiencies interact with other weaknesses. Finally, how are these communicated? Through a report to management, also called as management letter. This usually includes a covering letter and an appendix listing deficiencies along with recommendations to fix them. Okay, so let's quickly understand the covering letter. It is a letter in covering letter is a letter in the management report. The covering letter basically states the context and limits of the report. It clearly states that the deficiency listed are not a complete list, only those identified during normal audit procedures. The report is for the sole use of the company. It should not be shared with third parties, and without the auditor's written permission, obviously. And finally, the auditor accept no responsibility to any other parties. Learning the format of the cover letter is very important. It can be definitely not definitely, but it can be asked in your exam for 2 marks. So yeah, it's easy 2 marks in your hand if you just learn the format. Okay, so let's understand the appendix in the report to the management. This is where the real marks are scored in the exam. The appendix is presented in a table format with three key parts. First, deficiency, a clear description of what is wrong in the control system. Second, consequence, what could happen if the deficiency is not corrected. Always focus on what matters to the client, like loss of revenue, extra cost, fraud or stolen assets, errors in financial statements. Third, recommendation. This is a must. Directly address the specific deficiency, provide more benefit than cost, clearly explain how the control should work. You should also specify who will perform the control and how frequently it should be done. Okay, guys, I looked down from here. It's just the format you need to understand to write up exams answers in a better way. And yeah, it's easy marks if you understand the concept clearly. So till here, I'm guessing it's just this. It just teaches you how to write a good answer. So I'll continue in from here the seal system in my next video. If you really like the video, please like, share and subscribe to my channel and share it with your friends, and thank you so much for watching.